Hey everybody, Rob Maurer here, and today I wanted to spend some time going through the mechanics of a possible S&P 500 inclusion and some of the implications behind that potential inclusion. I want to focus on that for this episode, but obviously a lot going on with Tesla news-wise, so we'll cover some of that towards the end. Alright, so as we've talked about a lot, Tesla will become eligible for the S&P 500 if they report even $1 of GAAP profit in the upcoming Q2 earnings report on July 22nd. That fulfills the requirement of the last 4 quarters in summation being profitable, as well as the most recent quarter being profitable. With Tesla's delivery report for Q2 of over 90,000 vehicles, some of the Elon Musk leaked emails, and most recently the release of Tesla short shorts, expectations for Tesla to report that second quarter profit have risen. That matches my expectations as well. But even if Tesla doesn't, they should easily post a third quarter profit, which would again make them eligible for the S&P 500. The reason this is important is because the S&P 500 is indexed or benchmarked by multiple trillions of dollars of assets under management, and those funds that are tracking the S&P 500 need to purchase new shares of companies that are added to the index, because if they don't, well, their performance would then deviate from the index, and they wouldn't be doing a very good job of tracking it then in that case. That same logic indicates that these funds don't already have Tesla shares because it's not in the index. Therefore, we have a significant amount of tracking funds that need to buy new Tesla shares because they do not already own them. So then the questions that arise are, okay, how many shares actually need to be purchased, and how does the timing of all of this unfold? We'll start with the share count, and to understand that we need to understand the methodology of the S&P 500 index, which determines how much of the index is made up by a specific company by using the float adjusted market cap of that company compared to the others in the index. Breaking that down, the market cap is just the number of shares outstanding times the share price. And then the float adjustment, that just means that when the S&P 500 is looking at this stuff, they remove or exclude shares that are seen as illiquid. In the case of Tesla, shares that Elon Musk owns would be a good example of non-float shares. The gist of it is they're really just trying to isolate on the shares that are available for public trading. So to determine the weight or the portion of the index that the company will represent, that float market cap is just divided by the sum or the total float market cap of all the companies in the index. So let's take a closer look here at the mechanics for Tesla. The total outstanding share count that is used when we figure out the market cap for Tesla is about 185 million shares, but Yahoo lists the float share count at about 147 million shares. This is just an estimate, so you may see different numbers out there for float, and the S&P 500 may use their own definition of float as well. But we'll use the 147 million shares of float here that Yahoo has for our example. And then we also need to understand the total float market cap of the S&P 500. So to do that, we need the S&P 500's price, which as of close today on Monday was $3,155. And then we need something that the S&P 500 calls a divisor. That divisor is a little bit outside the scope of today's conversation, but essentially it's a variable used by the S&P 500 to properly benchmark the price of the index against its past performance when companies do weird things like buybacks or stock splits, or when companies are added or removed. All we really need to understand for today, though, is that if we multiply the price of the index by that divisor, which according to ycharts.com and backed up by another source that I found, currently sits at about 8.3 billion, meaning that the total S&P 500 float adjusted market cap is about $26.1 trillion, or just above 26,000 billions. If you're watching here on YouTube, that's how I have it displayed. At this point, to figure out the weight for Tesla, we just need to figure out the float market cap. So we take the 147 million shares times whatever the share price is. In this case, I'm using the example share price of 1,600, which gives a float market cap of right around $236 billion. Dividing that by the $26.1 trillion in the S&P 500 float market cap, that gives Tesla a weight of 0.91% for the total index. Now, this is where things get interesting. The S&P 500 in their most recent fact sheet says that for the S&P 500 specifically, quote, there is over 11.2 trillion US dollars indexed or benchmarked to the index, with index assets comprising approximately 4.6 trillion US dollars of this total, end quote. So $4.6 trillion in indexed assets and another $6.6 trillion benchmarking off that index. This is where we apply the weight that we just calculated. So at 0.91% of the total index, Tesla would then need to represent $41.6 billion of that $4.6 trillion in assets. Really simple math there, just 4.6 trillion times 0.91%. So under the scenario with Tesla at $1,600 per share, the index funds would need to own $41.6 billion of shares to be at that 0.91% weighting. That equates to just over 26 million shares. And remember, because they're tracking the index, they do not own these shares yet. If the float is about 147 million shares, that would mean that the index funds here would need to buy about 18% of the float. Whether we're talking shares here or percentages, it should be clear that that is significant. Under this scenario, that means that the index funds trying to purchase their Tesla positions would need to buy from about 1 out of every 5 current Tesla shareholders. If only 1 out of every 6 wants to sell at these prices or anywhere close to them, well, then that's where you see this price escalation. So far, we haven't even discussed the $6.6 trillion of assets that the S&P 500 says is benchmarked against the index. If all of those want an equal weight position on Tesla, as is in the index, that would mean another $60 billion in valuation to get to that 0.91%. That's another 37.3 million shares. So in total here, if all of that $11.2 trillion in assets gets to that 0.91% weighting on Tesla, that would be 63.4 million shares that would need to be purchased by these funds, or about 43% of the float. Now, certainly, at least in the $6.6 trillion of assets that is benchmarked against the S&P 500, some of those funds are already going to own Tesla. So that 63 million share number seems unlikely, but it's probably somewhere in between that 26 million and 63 million share count that needs to be purchased here if Tesla is added. These numbers might sound crazy, but they are supported by comments that were in the Reuters article on the topic that we talked about a couple days ago, which said that the head of index and ETF research at Virtue Financial, quote, estimates index managers would need to own roughly 25 million shares of Tesla stock, currently worth 34 billion, end quote. So here we end up with a similar number. Another question that I've seen out there is how Tesla's share price influences the number of shares that the index may need to buy. And it doesn't really matter too much in terms of the actual share count. So I put an example here of Tesla at 800. If we do that, the float market cap is 118 billion. Tesla's weight in the index then would be 0.45%. Applying that weighting to the 4.6 trillion in assets works out to 20.8 billion, which if you divide that by $800 is the exact same share count, 26.026 million. So the valuation of the shares needed changes significantly with Tesla's stock price, but the actual share count doesn't really change too much. And technically to me, it looks like the actual share count needed would go down as Tesla's share price increases, because as that float market cap becomes larger and larger, that would theoretically increase the total S&P 500 float market cap. In this example, Tesla at 1600, the float market cap is $118 billion more. So if we simply add that $118 billion in additional market cap to the total float market cap of the S&P 500, then all the same math that we went through works out to 25.9 million shares needed instead of the 26 million even. So no significant difference, but I did want to point that out. All right, so in terms of the impact for what this might mean for the stock, I don't know. It's anybody's best guess. None of this is financial advice, by the way. But obviously, if 26 million shares need to be purchased, that definitely boosts the demand side of the supply and demand pricing curve. This isn't a perfect proxy by any means, but we can look at short interest. And if we go back to August or July of 2019, the number of shares sold short on Tesla stock was around 40 million shares. That's down now to about 14 million shares, so 26 million share variance there. And the share price has gone from 200, 250 or so, obviously now to around 1,500. Obviously, tons of other factors on the share price, not just short interest, but still an interesting comparison nonetheless. Another interesting element to consider here as we think about those shares is that, as has been pointed out on Twitter by the account Tesla_truth, Tesla is not actually in the S&P 400. The S&P 400 is a mid-cap index, or for companies less valuable than those included in the S&P 500, which is a large-cap index. And oftentimes, when a company is added to the S&P 500, they sort of graduate from the S&P 400, and in some cases, an organization may have funds tracking both indices. So if the company moves from the S&P 400 to the S&P 500, that organization would already have some shares that they would need to meet their purchasing requirement for the S&P 500 inclusion. But with Tesla, since it was not in the S&P 400, that would not apply, further increasing the demand for new shares of Tesla to be purchased. Directionally, it does seem like there will need to be a lot of buying, so let's talk about the timing of all of this. I've seen a lot of people talking about the S&P 500's quarterly rebalancing dates and trying to determine an announcement date for a potential Tesla inclusion into the index based on those quarterly rebalancing dates. But the rebalancing dates are used for weighting. The S&P 500 can actually add a stock at any time. If you look through Wikipedia's list of S&P 500 companies, you can see the date first added for each company, and there are companies that have been added in every month of the year, and sometimes there are months that have 2 dates where companies will be added. The most recent company to be added was West Pharmaceutical Services, or ticker WST. I don't know exactly what made them eligible, but they last reported earnings on April 23rd. the S&P 500 inclusion was announced a little bit less than a month later on May 18th, and they were added to the index on May 22nd. The next two companies were Domino's and Dexcom. They announced earnings on April 23rd and April 28th, respectively. Their S&P 500 inclusion was announced on May 6th, and they were added to the index on May 12th. The last example I'll give here is Twitter, because I know that was a case similarly to Tesla, where they just needed to announce that final profitable quarter. They announced that earnings on April 25th of 2018. The S&P 500 announced inclusion on June 4th and added to the index on June 7th. So if you're not following the timelines that well, it can be kind of all over the place, anywhere from a couple weeks up to maybe around 6 weeks or so. And then from when it is announced, there's generally a few days, maybe 3 to 7 days, before the company is officially added to the index. Again, this is where things get interesting, because according to the research that I've done, the funds tracking the index can actually add the stock before that announcement happens, and certainly before the inclusion happens. In addition to all the research that I've been doing on this, I spoke with a listener who works in the markets, well informed, and has a highly qualified source at the center of the indexing industry, which for anonymity's sake is the best I can do in terms of description. You'll just have to decide whether or not to trust me that it is a good source, but I do think it's a very good source. And our listener posed the question to this source about timing and whether all the buying would happen once the inclusion is announced. So he said, quote, "I asked him if it's a singular moment, and he said no. The managers have a pretty good sense that something's going to come in," end quote. Our listener then continued to say, quote, "He said they basically have the month prior and the month after," end quote. The reason given in the context behind this is that some hedge funds can make a living front-running this trade, as we've talked about. So the index funds are given leeway to buy ahead of time or afterward, because obviously all of that buying, if it were to happen in one instant, would cause the share price to shoot way up, and then those index funds are having to pay more per share, which would in turn hurt the performance of the fund. So to prevent that, the buying is spread out how I imagine it. This is purely my own speculation, but I would imagine that there's probably a bell curve with the most shares being purchased near that announcement or inclusion date, as that would likely get you closest to the actual performance of the S&P 500 index, and you don't really want to underperform the benchmark when essentially you are the benchmark. This perspective seems to be validated in an article written by longtime chair of the index committee for S&P Global, David Blitzer, in which he writes, quote, "A portfolio manager running an S&P 500 fund is not constrained to buy only at the close on the day the stock is added to the index. He or she can buy at any time, can spread their purchases over a few days or weeks if they believe they will get a better price. The flexibility gives the portfolio manager an opportunity to time the buying to his advantage and use his understanding of the index. Some hedge fund managers and speculators do buy when an index ad is announced and expect to sell to an index fund a few days later. Some may also forecast, parentheses guess, what stock will be added next and buy in advance. All this activity increases the liquidity of the stock being added and can dampen any price movements," end quote. So S&P 500 index funds can be buying at any time. Hedge funds right now can be buying speculatively to sell off later to the funds that need these shares. But this definitely seems to be an element at play for Tesla stock right now, as expectations for a second quarter profit and eligibility for inclusion in the S&P 500 have risen. All right, so I think that covers timing. I think that covers waiting, but there are a few other elements here I want to discuss. My source made sure to emphasize that it's important to recognize that the S&P Selection Committee does have a role here. They're not just rubber stamping things that meet the eligibility requirements. And as it relates to Tesla, one of the things that may be an issue is the liquidity of the stock. Now, obviously the volume is pretty high, but a lot of shares are locked up by Elon Musk and other insiders that aren't going to sell. And I think as the last few weeks have demonstrated, there are a lot of long-term holders in the stock aside from that group. And especially so with this amount of shares needing to be added, liquidity could be a concern. What's really interesting here is that according to this source, other companies have been asked by the S&P 500 Selection Committee if they will do a secondary offering to help improve liquidity. So that has the impact of raising capital as well. If it were Tesla, they would issue new shares at whatever price, and those new shares would then be added to the float. In the case of Tesla, right now they're sitting at about a $275 billion market cap, meaning they could easily raise $5 billion with less than 2% dilution. So they could issue 3.3 million new shares at $1,500 per share, raise that capital, and if they could, use it to accelerate expansion or to improve the balance sheet. But what's mind-blowing about it is even raising $5 billion and only adding those 3 million shares, that doesn't go very far if 26 million shares do indeed need to be bought. So maybe Tesla could even do a bigger raise, but the perspective from this source seems to be that Tesla will at least be asked to do a secondary offering, though of course that would be up to Tesla to decide. Personally, I'm a little bit indifferent on raising capital. If Tesla feels like they can utilize it, definitely go for it. But they have said before that they are not capital constrained, and I think free cash flow is going to start to look pretty incredible here pretty soon. But if they did raise, I do think that the market would love it. The other potential liquidity factor that has been mentioned is the possibility of a stock split. I've seen conflicting analysis on whether that actually does improve liquidity. I think that probably needs to be its own standalone episode, but Musk has said that he will consider it. One of our listeners and patrons actually on Twitter, Tesla in the Gong, suggested that to Elon, and he said, quote, "Worth discussing at annual shareholders meeting," end quote. That was on June 30th. This was after Tesla rescheduled their shareholder meeting to September, which is important because otherwise the Q2 earnings report would look like a prime opportunity to announce a stock split, but Elon is saying here that it'll be discussed potentially in September. All right, I think that covers everything I have right now for the S&P 500, but let me know what questions you have. We can of course come back to this topic if we get new information, so please let me know your thoughts, and I'll again do a shameless plug here. I do put a lot of research into this and provide it for free. If you want to help me do that, you can support at patreon.com/Tesla Daily Podcast. All right, so this is a really long episode already. We're going to keep these next thoughts brief, but I did want to provide a little bit of context on my thoughts on the day. Obviously, the share price was all over the place. There was more than a $300 swing on Tesla today. But if you zoom out and you actually just look at the graphs of the S&P 500, the NASDAQ, and Tesla, the shape is the same. Tesla was just amplifying those macro movements. Makes sense. Obviously, Tesla is very volatile right now with all of the speculation, especially as we head into earnings. There was also some more reporting today of what we talked about last week with margin requirements being increased. That may have caused some selling. And then whenever you have big dips like this, especially in a stock that has risen so much so quickly, a lot of people are going to have stop losses on that stock. Personally, I hate stop losses. I think it's a great way to give away your shares for less than they're worth, but it does protect you, I guess, against some black swan downside, and certainly they're of use if you are just day trading. But those stop losses can amplify negative momentum as they get triggered. That causes more selling, causing more stop losses to get triggered, etc. So that probably played a role today, but nothing I'm concerned about. I still am very bullish, as hopefully this episode demonstrates. And we're already seeing a rise after hours as Alex Potter of Piper Sandler, who we've had on the podcast a couple times in the past, has increased his price target on Tesla from $939 per share to $2,322, a new high for Wall Street. In the interest of time, I wrote an article earlier today on that on thestreet.com, so I'll put that in the show notes. Some of my thoughts on that are there. And then, of course, the other big news from this weekend is that Tesla has lowered the price on the Model Y by $3,000. Elon also announced on Twitter that they currently don't have plans to produce a standard range Model Y. That's a big change. He said he doesn't feel that the range would be adequate, which is a bit puzzling, but that instead, Tesla will offer a long-range single-motor Model Y. Pending the news tomorrow, I think we'll go into more detail on that topic and my thoughts tomorrow. So that is where we will leave it for today. As always, huge thank you for listening. Don't forget to subscribe and sign up for notifications. Make sure you're following me on Twitter at Tesla Podcast, and I'll see you tomorrow for the Tuesday, July 14th episode of Tesla Daily. Thank you.